So we should be live in the next 5 to 7 seconds. And Amaya sir, you can now go ahead. We are live.
Yeah. Jai Shri Ram. Greetings to everyone of the Republic Day. Uh, I welcome all of you for this first webinar on the topic of why and how I invest in mutual funds on behalf of our group Stock Market Discussions. It's the first webinar of our group, and I must extend my deepest gratitude to all of you busy doctors who have taken precious time out from your busy schedules to join for today's afternoon. We started with Jai Shri Ram. Ram Nam is very powerful. When we wanted to have a webinar, we wanted a Zoom subscription. And whenever we said Jai, Dr. Jai came with a powerful Zoom subscription of almost 1,000 people. So uh, I think we can have a good learning for today's afternoon. Stock market discussions is a WhatsApp group. You all are a part of it. It began in 2018 by close friends and stock market enthusiasts. I think the core inspiration is Dr. Ritesh Agrawal sir, who had handpicked mentors as well as people to join the group. It is amongst close friends and stock market enthusiasts. We are not populists, but focused group meant for closely knit fraternity to enable successful participation in active investing by the medical fraternity. The vision is to have authentic knowledge sharing and information sharing so that there is a meaningful, constructive investing as well as financial independence. The pillars of the group include Dr. Ritesh Agrawal sir, who has been the group is his brainchild. Dr. Neeraj Jindal sir, who is a excellent technical analyst. Dr. Prashant Mishra sir, I think he's a superstar. His Twitter followers have touched almost a million and a very good fundamental on ground analyst. Dr. Ashok Shukla sir, someone who is I will call strategist, and his we know his strategists help not only to achieve gains but also to conserve gains. The group discusses on technical and fundamental aspects, all kinds of stocks, large to micro caps, mutual funds, which is going to be today's topic, different ways of investments. And we also have polls, which give us an insight about what we all are thinking. And icing on the cake is a discussion after the polls where all of us get a constructive way ahead. And then we also try to look at other investment opportunities from time to time. It's a very successful group with more than 1,400 members, closely knit fraternity. As I said, we are not populist, but focused, closely knit people connected. Many stalwarts whose opinion matters to millions are members of the group, and we are privileged to have them. And it's a tightly regulated group which very much focused on sensible, related, meaningful messages without any wishes or greetings, which you will find in all groups, sort of disturbing the flow of the chats. And all the members of the group are respectful and polite, here only to learn. As we move on to the webinar, my request to all of you will be stay muted. Put your queries in the chat box, which will be taken by our moderators in the end, which you will have, which definitely will be attended. And stay active so that end of the day we are better learned and informed. We can also have some constructive queries in the group. We are privileged to have moderators, Dr. Ritesh Agrawal sir, who is the first endocrine surgeon in the city of Mumbai, attached to multiple hospitals, and he is the brain behind our group. And Dr. Jai Mehta sir, who is an IVF specialist in the city of Mumbai. It's my privilege to hand over the session to Dr. Ritesh Agrawal sir. Dr. Ritesh sir, over to you. Dr. Ritesh, please unmute.
Yeah. Dr. Ritesh, you are unmuted.
Okay,
You
thank
just
you.
need to press on unmute.
Yes. So thank you, Amir sir, so much. Thank you, Jai Bhai, for providing us your platform. A special thanks to Bhagali sir for allowing us to host his webinar. He's an excellent speaker. Jai Shri Ram and welcome you all. It is my privilege to introduce our Master of Ceremony, Amir sir also. Amir sir is one of the topmost leading endocrinologists in our country. And people would not be knowing, but my market value has increased a lot because patients call me and say अमिया सर का अपॉइंटमेंट 3 महीने का नहीं मिलता है. So I call him and they get appointment within 1 or 2 days only. So they also have a lot of respect for me because of this thing. Thank you, Amir sir. So the topic for today is mutual funds. Mutual funds are a very good thing for money making if managed properly. Bhagali sir will tell about more about the mutual funds. But remember, even the small amounts by keeping in mutual funds in SIPs regularly will make a huge bulk after few decades. So be disciplined, learn about mutual funds, and keep invested in the mutual funds. Do not try to break your SIPs even when the market is down. It is very important. Many people have committed this mistake. Don't do this further now. Just stay invested in mutual funds and you will gain a lot. You will create a good wealth after a few decades. But the importance is patience. Patience is the key. So here I will hand over now the mic to Dr. Jay Mehta sir. Please introduce Bhagali sir and Bhagali sir will take over then.
Yeah. Hi everyone and good afternoon. So first of all, a big congratulations to Ritesh bhai. We had the privilege of starting our practices together way back in 2015, 2016, and I have seen him grow from strength to strength, and it's just so amazing that he's available and he's such a good mentor to a lot of people and this entire group. So all the best to everyone who is contributing so nicely. And as we all know, Nitin Bagali sir is a well-known orthopedic surgeon practicing in Pune, and sir will be discussing in today's session about how and why and when to invest in mutual funds and whatever is his approach towards it. So we don't really want to waste time, and we'll hand over the mic to Nitin Bagali sir. Sir, you can go live. We've enabled permission for you to do the screen sharing as well.
Yeah. Thank you. Somebody else is sharing the screen. He has to
Yeah,
stop
Dr.
sharing the screen. Without that, I
Dr.
can
Amaya,
start.
can you stop sharing the screen? Dr. Amaya Joshi, can you stop sharing the screen? Right, sir. I think now, yes, sir. Done.
Yes.
So you can share the screen now. We've seen that you're sharing the screen, that there's nothing coming up though. Yeah, now we can see it, sir.
Yeah. This is for the Republic Day to all of you. I am not very aged, but still, I have lots of points to convey to all of you. Quite a bit from this presentation. It is my experience of say 7 years. I have been investing in the mutual funds since 2017, and just today morning itself, I have studied my mutual fund portfolio. My mutual fund portfolio is not even 10% of my total investments in the equities, but still it has generated a return of 15.84% in last 7 years. It is CAGR, compounded annual return of 15.84 is not bad at all, without any hassle. Now, coming to the goals of investment and basics of mutual fund, let me start with what is wealth creation. There are three aspects of creating wealth. One is earning. We as doctors are good at earning. Second is preservation. Some of us might be very good in preserving what we have earned. and third is multiplication. By and large, whatever friends and colleagues I have interacted with, what I have found, their knowledge about multiplication is below average. They do not know the basic laws of taxation and they lose very heavily on taxes and multiplication. Doctors are good at wealth creation, but not at multiplication. Have a limited knowledge of finance, investment. Most of us are self-employed. We need to provide for repayment of loans, taxes, hospital and family learning expenses, contingencies, children's education, or settlement during active years and retirement. Let us start with the basics of investment. Very few really understand the power of compounding. So, if I invest rupees 1,000 at the rate
Bagali
of
sir,
interest
sorry
of
to interrupt
12%
you.
per
Your
annum,
slides are not moving. Dr. Bagali, your slides are
huh?
not moving actually. Your slides are not moving through.
Yes,
Your slides, you unable to move through the slides. We are just on the first slide,
slides
and
are
I guess you've
not.
reached. Your slides are not moving forward. On the screen sharing, you need to ensure that your slides move forward, sir.
Now, on my
You
screen, they
need to
are
click on the
moving.
presentation mode, sir. No, sir. You need to click on the presentation mode below on the right bottom corner. Besides the minus sign, there is a mode of presentation. You just need to click on that, sir.
I am pressing there only.
No, sir. We can only see the first slide here. Even on the live, we can just see the goals of investment and basics of mutual funds. We can't see the other slides, sir. So we must do one thing. Just stop your screen sharing and start again, sir. No,
See
no.
now?
So you just need to stop your screen sharing and restart it, sir. That will solve the problem.
Huh? Please.
Yeah. So just
Okay.
stop the screen sharing and restart it. That's it. That's all we need to do. Yeah. You can now restart your screen sharing, sir. Kindly restart it. And you need to click on the right bottom corner. Yeah, just click on that, sir. That's the presentation mode. Just click on that.
Yeah. I pressed there only.
Correct, sir. Now it is loading. See, now it is just.
Is it okay now?
Can you try to move your slide, sir?
I'm
So
moving.
do one thing. Point onto the slide number 2 and try to go onto the slide number 2.
How do I do it?
Okay, just press escape on it, sir. Now when you do screen sharing, sir, go to your desktop. Just go to your desktop.
I'm on the
Just
laptop.
stop the screen sharing. Go to your laptop again, sir. And once your laptop screen is shared, don't share the PowerPoint, sir. Go to your laptop screen and then share it. Okay.
Okay.
Yeah. Could you please start the screen sharing and go to your go to the home page of your laptop or desktop or your iPad?
Now I am on the laptop. There's a laptop screen.
Yeah, so we can't see your screen. We at the moment we can only see you. We can't see your screen.
To stop sharing screen, no?
Yeah, now restart it, sir. Now restart it. So are you able to restart your screen sharing, sir?
No.
Okay, wait. So Dr. Neeraj, you wanted to give an input to this.
Yes.
Please do that.
Dr. Bagli, now just follow a step-by-step instruction. Click
Okay.
on share screen at the bottom. Do you see the share screen with the green arrow? If you're not able to see, just press escape.
I've gone out. Are you
Yes.
able to
So
hear
now,
me?
are you able to see your green share screen button?
No, no.
On the Zoom, what do you see then? Where is your video? Can you see my video? Can you see my
I'm
video?
seeing only one slide, Vijlani, that's it.
Yes, you are seeing my video, right? You can see my face. I'll do one thing. I'll do a video call to you. Where is your phone?
Yeah, share screen.
Yeah, share screen. Then you click on the first option on the left. It's called screen. First option on the left. When you click on share screen, you will get a pop-up window. And on that, on the left side, you'll get the first option called screen. Can you see it?
No.
Okay, I'll do one thing. I'll do a video call to you. Just pick up your video call and show me your screen. No, again, you have shared the wrong screen. Just stop it. Just pick up my video call.
हाँ.
WhatsApp में yes. Now show me your screen. No, show me your screen. See, आप नीचे वाले स्क्रीन में देखिएगा आपको क्या दिखा रहा है. Yes. अभी वो ग्रीन बटन दिख रहा है ना, उस पर क्लिक कीजिए आप.
ये ना.
नीचे दिख रहा है, ये वाला है. क्लिक कीजिए. थोड़ा ऊपर लेके जाइए, मेरे को दिख नहीं रहा है. हाँ. ग्रीन बटन पे क्लिक कीजिए. Yes. Click on green button. Yes. Now the first option दिख रहा है स्क्रीन. देखिए स्क्रीन लिखा हुआ है नीरज गुजरानी लिखा हुआ है.
ये.
डबल क्लिक. Yes. डबल क्लिक.
किया.
अभी पावर पॉइंट चालू कीजिए. स्लाइड शो मोड में जाइए. नीचे स्लाइड शो मोड. नीचे राइट साइड पे देखिए. क्लिक. हाँ. उधर उसके बाद में यस वो वाला चालू कीजिए. यस. गो अहेड.
Now?
It's good now. It's good now.
Okay.
Go ahead, sir.
So basically, wealth creation involves three aspects: earning, preservation, and multiplication. Doctors are good at wealth creation, but they are not good at multiplication. They have a very limited knowledge of finance, investment, borrowing, or expansion of own profession. Most are self-employed, need to provide for repayment of loans, taxes, hospital and family running expenses, contingencies, children's education, or settlement during active earning years and then later retirement. First basic of investment is to understand the power of compounding. So if you invest with rupees 1,000 at the rate of 12%, what will happen to your money after 10 years if you are not going to withdraw your interest? And interest will keep on adding on the interest and it will generate more and more money. After 10 years, it's going to be 3,262 rupees. After 20 years, it's going to grow to 10,641. And after 30 years, it's going to be 34,711. So that's the power of compounding. You have invested just rupees 1,000 at the rate of 12%, and just hold on to that investment for such a long time, your money is going to grow. The bigger the amount, bigger is the effect of compounding. So if you start investing at the age of 25, contribution per month of about say 1,000 rupees a month, and rate of return is around 15%, then the corpus created at the age of 60 is going to be 1.23 crores. But if you start 5 years later, at the age of 30, it's going to be just 60 lakhs, less than half. And if you start another 5 years later, rate of interest remains same, but then the corpus will be just 29 lakh rupees. So the message which I wanted to give, those who want to build a corpus need to start early and be patient to reap the benefits of compounding. Regular investment yields more than the lump sum. So why people insist on SIP? Here is the answer. So if you start investing, Dr. A invests 5,000 rupees a month, while Dr. B, though the annual sum is same, he does it only in one lump sum, 60,000 rupees per year. And the duration of investment is say 30 years. Rate of interest is 12%. So Dr. A makes 360 contributions in 30 years, while Dr. B makes just 30 contributions in 30 years. The final corpus Dr. A gets is 1.74 crores, while Dr. B gets 1.44 crores. So there's a whooping 30 lakhs difference just by being more disciplined and saving monthly in a SIP mode. Now, what should be the goals of investment? I at least follow these 4 goals very rigidly. 1, it should beat inflation. So it should be your return from any investment should be minimum 12% per year. And how do you know it? Wealth quadruples 4 times in 1 decade, or it doubles every 5 years. So that's the rate of return you should aim at. Number 2, this is the most important thing which doctors fail to understand. Difference in the pre-tax returns and post-tax returns should be minimum. Any investment we do is to generate regular income in future. And that regular income, we should not waste hell of it from paying taxes. Saving on taxes is the key for becoming a successful investor. So difference in pre-tax returns and post-tax returns should be minimum. 3, you should have a mechanism to protect the wealth from sudden liability or volatility in the markets, and the transmission of wealth to the future generations should be hassle-free. Point number 3 and point number 4 we are not going to elaborate or discuss it today. Sometimes later we will come to it. Now let us understand what's inflation. It is the rate at which currency loses its value. Value is nothing but the purchasing power of the currency. As the time goes by, one has to pay more for the same amount of goods or services over a period of time. Now, when government announces the figures of inflation, they give 50% weightage to food and grocery items. Do we really spend 50% of our income or savings on food, grocery bill? No. We are all belonging to elite community. We are all doctors. We earn handsome amount of money. Our lifestyle is different. So we spend on very good education of our children. We spend on leisure holidays. We spend on club memberships. We spend on advanced medical care for ourselves and our family members, which is growing at a much higher rate than food inflation, say around 15 to 16%. Education is inflating at a rate of 16%. Medical care is inflating at a rate of 15% every year. So if you take an average of CPI and lifestyle inflation, as it is called, then we must aim for minimum 12% return annually from any asset. So now what has happened? See, the return of various assets in last 37 years. This figure is from 1980 to 2017. And we are just considering the inflation. We are not taking into consideration any taxes outgo. So if you put a lakh of rupees in fixed deposit, in 37 years, it has grown to 20 lakhs. It is 20 times. So the annualized return then in early 80s, the rate of interests were high, 80s, 90s. So annualized return, what we get as an interest is 8.39%. And inflation over last 37 years, if you take the average, was 7.67%, government figures. So inflation adjusted return is just 0.72%. We have not taken taxes into consideration in this table. Similarly, gold, it would have grown to 37 lakhs, giving you an inflation adjusted return of 2.54%. Silver, 1.35%. It is Sensex, which has given the highest return, say 10.33%. And if you have unaccounted cash and kept in lockers, it would have become negative. It diminishes with inflation and it would have given you a return of minus 95%. So keeping cash it's the most foolish thing we can do as a doctor. Now let us come to what is post-tax and post-inflation return. See, if we keep rupees 100 at a rate of interest of 8% in any asset class, after 1 year, it's going to grow to 108 rupees. We all are at tax slab of 30% plus. I am not considering cess and surcharge here. But just see, if we spend 30% of that 8 rupees towards tax, what we really get in hand is rupees 5 paise 60. Now consider the inflation of 5% as on today. So 5.6 minus 5 is just 60 paisa return post-tax and post-inflation. So it's very, very meager return, which is hardly going to generate any wealth. Now let us look at the asset products we commonly use. There are two types of products. One is asset creation product and the other is asset protection product. Let us look at the asset creation products. Now, what are the classes of assets? Financial assets, physical assets, and alternative assets. And in financial assets, we have fixed deposits, direct equity, RBI bonds, provident fund, mutual funds, which is the topic of discussion today, post office savings, corporate deposits, overseas funds, paper gold, etc. Physical assets are gold, precious jewels, antiques, coins, paintings, and higher assets, non-convertible debentures, real estate investment trusts, private equity funds, hedge funds, sovereign gold bonds, gold ETFs, infrastructure funds, venture capital funds, etc., etc. So financial assets is the key to get tax saving and wealth creation. Now, planning of finances usually depends on the age of the individual, his status, whether he is employed with a fixed income, stability of the job, whether he is self-employed or entrepreneur. Again, stability of income is very important. Family responsibilities, whether any of other your family members have another source of income or you have another source of income, financial goals, duration to achieve those goals, and your risk appetite. Again, risk appetite will depend always on the stability and the quantum of your income. Now, coming to mutual funds. What is a mutual fund? Mutual fund is a pool of money which is managed by a professional fund manager. Asset management company is the trust which collects money from a large number of investors who share a common investment objective and invest same in various assets like equities, bonds, currency, money market instruments, and other securities. Now, if you see this slide will show you a story from year 2000, how the Sensex has given return against the fixed income securities like fixed deposits or debt. So Sensex is probably the only asset class, equities, which will give you such a decent return over a long time. Patience is the key. Now, what are the advantages of putting your money in mutual funds? Simple to invest. Even if you don't know anything about the equities and stock picking, you are hiring the services of an expert who can invest your money in the best of equities for you. It is professionally managed. It will offer you diversification, which is most important. As a small investor, we have limited funds, especially initially in our career, where though we like 10 scripts, we hardly have resources to put money in 10 scripts. So who is going to do it for you? The common pool of investment, mutual fund. So it will give you diversification. It is very conveniently administered. It's very transparent. It gives higher returns. And comparatively, if you compare it with the portfolio management services and other things, it is low cost management. It offers liquidity. Whenever you sell your funds, you get your returns within 2 to 3 days. And if you sell them on a application platforms, you can get your money within a week. It provides transparency. It is highly regulated because of stringent rules and regulations by security enforcement agencies. And there is a possibility to switch from one fund to another very easily, though paying taxes. Now, see here. See on the left part of the slide, right slide will come to it later. if you have put your money in a recurring deposit, say if you are putting 10,000 rupees aside at an interest rate of 6%, investment tenure is 5 years, and tax rate, as I've said, 30%. What you have earned really after the fixed deposit is 97,818. Against a mutual fund SIP, you get 1,25,766. Why? Because your tax outgo after fixed deposit is higher than otherwise. So return you actually get in a recurrent fixed deposit post-tax is 4.32%, while for mutual fund it is 5.91%, more than 1.5%, and 6% per annum is the only quantum which we have considered. Mutual funds give much more return than what is said here, but still, even at the same rate of return, your returns can be better because of saving in the taxes. Now, what are the types of funds? The classification of funds depends on various types. Types of mutual funds according to tenure: open-ended funds and closed-ended funds. Open-ended funds are perpetual funds. You can enter anytime, you can quit anytime with exit loads if you are living in very short time frame. Then types of funds depend on the structure of the fund, whether it's equity fund, a debt fund, or a hybrid fund. Equity fund is a fund, it's a mutual fund where your fund investor will put at least 65% of the corpus in equity instruments. While debt fund, it will be less than 35%, and usually it is 75-25, where 25% of the money will be put in equity in a hybrid fund and 75% will be in the debt fund. Hybrid fund is a mixture of debt, equity, and at times even gold and real estate. I will come to those funds very shortly. Now, in equity funds, we have various categories: large cap funds, mid cap funds, small cap funds, micro cap funds, multi cap funds, and flexi cap funds. So large cap funds are the funds, means your money will be invested in top 100 companies of the index. Normally, this position is decided by the market capitalization of a company. Now, what is market capitalization? It is the weightage of that company holds in an index according to the price of the share in the market and multiplied by floating stock of that company's shares in the market. So it's a market capitalization is equal to price multiplied by floating stock of that particular scrip. Now 1 to 100, they are known as large cap companies by market capitalization. Roughly you can say market capitalization of more than 20,000 crores is a large cap company. Mid cap company is from 101 to 250th rank by market capitalization. So here the market capitalization is smaller, risk is higher. Large cap companies, if somebody wants to take over these companies, they have to spend a huge amount of money. So takeover bids are not that easy in large cap companies, so they are more stable. They have been there in the market for a number of years. They have established credentials. Mid cap companies are smaller in size. Takeover bids are possible. They are more volatile, but then the return and risk is commensurate. High risk, high return. Small cap is still lesser. Company number 251 from market capitalization to 500. They're all small cap companies. Here, takeover bids can be very easy. Market capitalization is low. Volatility is higher. Higher the risk, higher the return. Same formula applies here. Micro cap companies, anything above below 501, where the market capitalization is also low, less than say 2,000 crores. They are known as micro cap companies. Here, they are usually the fresh entrants. They have to prove and establish their credentials. Takeovers can be easy. Promoters can offload their stakes very easily. Multi-cap means the fund manager will invest your money in different classes of equities, large cap, mid cap, small cap. According to his study and predictions, he can switch from one category to another category at will. Flexi cap is again same. And in multi-cap, risk is higher, returns are also better. Now you see at this chart is very important. If you see 1 year return, S&P BSE index in last 1 year was say 18%. Your mid cap return was 45%. And your small cap return was 46%. In last 3 years, large cap gave you a 20% CAGR, mid cap gave 35%, and small cap continued to give you 46%. Over 5 years, your large cap gave you returns of 14%, mid cap gave 16%, and small cap gave 19%. And this is over 10 years. Now, mutual funds category. This is data on 31st of December 2013. Mutual funds category, you can see upper returns were of the Sensex or index, Indian market returns. And now look at the returns from the funds. Large cap funds, mid cap funds, small cap funds. They have all done well except the small cap in 3 years category has given lesser return than the index or the real market fund. So mutual funds continue to do better than the Sensex itself, provided your fund managers are competent. Now, what are debt funds? Debt funds is your money, those who do not want to take higher risks, but still want to fetch better returns than the bank fixed deposits, they can put their money in debt funds. The fund manager will put your money in various government securities, financial instruments like corporate bonds, and money market instruments. Now, debt funds again will have different categories. If the company which is accepting that money as a loan, if it's very established with good financial credentials, then it's a low risk debt fund, but the returns they will offer will also be very low as compared to high risk. The company which has yet to prove its credit worthiness, so higher credit risk category, they will give you a higher rate of interest, but there will be associated risk and it can fail, like Franklin Templeton's high risk credit debt fund collapsed. Hybrid funds, they can be conservative and aggressive. Here, the fund manager will put your money in aggressive fund, more allocation will be towards equities because equities carry higher return, but it's associated with higher risk as well. While the conservative fund, he will allocate more money to debt and less money to equity to preserve the capital, because the goal of the investor is to be safe. Now, what are the types of various hybrid funds? The latest baby is multi-asset funds, where a fund manager has a choice to invest in at least 3 asset classes like gold, debt, and equity, or real estate, equities, and debt, whatever permutation or combination he may prefer to do depending on the market conditions, but he must invest at least 10% allocation to each class. And if he sticks to the basic principle of 65% allocation to the equity, he will have the benefits of taxation for equities that is lesser than the debt fund. Aggressive hybrid fund, I have already told you, 65 to 80% in equity and 35 to 20% investment in debt instruments. That's aggressive because more allocation is in equity with more risk. Now, dynamic asset allocation or balanced advantage fund, these are all play of words and it's difficult to understand in the beginning. These are truly dynamic and they can shift between 100% debt to 100% equity as an asset class. So fund manager will take a call depending on the market dynamics and geopolitical situation and safeguard the interest of the investor. Conservative hybrid funds 10 to 25% in equities and 90 to 75, 10 to maximum 25% in equities and 90 to 75% in debt, not equities. I'm sorry. These players play in both the cash market and futures and options market simultaneously. They buy from the cash market and sell in the futures market simultaneously, and they try to encash the price differential between the two markets and make money. It's a safe game, but returns are not as handsome as an equity, direct equity fund. Now there are special funds, sectoral funds. Many sectors have split out and they have their own indices: banking and financial, IT, manufacturing, agrochem, specialty chemicals. New sectors are rising, and their indices are being designed, and you can invest selectively in such groups. Now currently, sunrise industry which we see, so defense fund has already come. EV fund may be coming, I don't know. So sectoral funds will invest your money only in that particular group of scripts. High risk, high reward is the category. Those who are willing to take risk, those who are younger with stable income can take such chance. There are quite a popular list of sectoral funds which is doing well in the market. Then international funds and foreign funds, where your money, we as common investor hardly have knowledge about companies in US, China, and various other countries which are prospering economically. Experts will invest your money in foreign funds or foreign companies. Sometime back it was Russia, Argentina. Your money will be invested in either overseas, these emerging market funds or emerging market scripts. Pension funds or retirement saving plans. Here the stability is most important. So most of your money will be allocated in a very safe debt or corporate debt category, and a little amount will be allocated to large cap scripts for stability of income and safety. Index funds. This is a very important category which I'll come to a little later. Exchange traded funds and fund of funds. Let me finish with the fund of funds first. Fund of funds is a recent category which is very successful. The fund houses, they follow other leading funds in the market. They study their performance, and instead of using their brain to allocate money in equities or debt, they will allocate your money into successful funds which are performing well. It's a very nice idea. ICICI Pru Bharat 22 is a very, very successful fund of funds. And overseas funds, again, they have been doing it for so many years, like Franklin Templeton invest money in their parent companies' US funds. Now, goal-based funds. There are growth funds, regular income funds, and tax saving plans. Growth funds is the area which interests us, because once you start generating regular income from the regular income fund, that income is distributed amongst the investor as dividends. Dividends are now fully taxable in the hands of recipients. So you lose heavily on taxes. Growth fund, you are going to retain your profits with the company itself, and if you hold them for a long compared to dividends. And tax saving plan, of course, we know if you invest in tax saving instruments, equity linked saving schemes, there is a lock-in period of 3 years, but investment up to 150,000 rupees or 1,50,000 rupees will be tax-free under Section 80C of the income tax. Mutual funds are further classified into growth funds, income funds, liquid funds. 1 month, 3 months. And that money can appreciate a little better than the savings bank interest account. And it has to be withdrawn within a stipulated time frame according to the fund house. Tax saving funds, which I already told you, and other funds we already talked. Now, fixed maturity plans are closed-ended funds. They are not large in number, they are very few actually. They invest your money in bonds, securities, and money market. The maturity date for that fund is planned. When the fund is offered, new fund offering, NFO, there is a limited time span, say about a month, when you can enter into these funds. Your entry later is not entertained. So within a month of opening of this fund, you have to put your money and hold on to at least 3, 4, or 5 years, whatever may be the maturity period decided by the fund manager. So entry period is restricted. Fund manager handles the investment smartly and plays with the prevalent rate of interest and the coupon rate to make money by arbitrage. He knows the client is going to stick with him for 3 years or 4 years or 5 years. So he has a liberty to manipulate the corpus according to his will and generate smarter returns than ordinary debt. Pension funds. Investors' money needs to be invested in a safe and secured assets which will return decent and regular returns. Part of it can be invested in high risk return asset class like equities to enhance the returns. What are the popular schemes? National Fund Plan, HDFC Retirement Plan. They are the good examples of these pension funds. Now, what is an exchange traded fund? These mutual funds are like stocks. They are listed and traded on the stock exchanges like share throughout the trading hours. Index fund is a fund where money is put by the fund manager in the scripts which comprise the index. Say BIC Sensex, it is comprised of 30 leading scripts. Nifty 50, it consists of leading 50 companies. Next 50 is next 50 companies, like that. So the index fund manager will track an index like Sensex or Nifty by holding the stocks exactly in the same weight as the benchmark index. So he doesn't have to use his brain. Computer will do the job. It can be traded anytime during trading hours and it will need a demat account. So that's the only inconvenience for an investor. The benefit is low cost because since the fund manager doesn't have to use his brain, expense ratio will be very less, will be less than 0.5%. Managed funds. Liquidity is excellent. It is transparent because investor doesn't have to know from any other source what stocks fund holds and at what proportion. No study is required. There is no error from the fund manager's problem. Efficient market hypothesis. No fund manager can outperform the benchmark consistently, even otherwise. So instead of spending heavily on an expense ratio, one can smartly do index fund. This is one of the best options for retired persons where they can put their money in an index fund. Your expense ratio is less. You are getting returns at the rate of say Sensex or Nifty, and you can set in a systemic withdrawal plan where your taxation is going to be very poor. To allocate the fund which you want to prepare for your retirement in the index funds and set in a systemic withdrawal plan where your taxation will be low, expense ratio will be low, and you will generate very decent returns. Now, limitations. SITS is going to track the index. It will never outperform the index. So it will not have very great alpha. There will be only limited growth upside as indices comprise of old and mature companies which have put their best years of growth behind. And you need a trading and demat account. Point 2 is also very important because almost the shares which comprise an index, they are not startups, they are established players in the market. Probably their best innings is already behind them. Now coming to the very important topic, why I insist of investment in equities or equity-based mutual fund is here. Taxation of mutual fund. It depends on the fund types, whether it's equity, debt, or hybrid fund. What are the sources of income from a mutual fund? One is dividend and two is capital gains. Dividend is a part of profit distributed amongst the investors by a mutual fund house, and that is known as dividend. It is fully taxable in the hands of the recipients. So the charm of saving taxes is gone. Two is capital gains. When the investors sell their holdings at a higher price than a buying price, the profit is termed as capital gains. Holding period. What is the holding period? It's the time between the date of purchase and date of sale period, less is the taxation. Now, taxation of capital gains. Equity funds. If you are holding an asset for less than 12 months, it will be called as short-term capital gains. And it will be long-term only if you hold it for 12 months and more. For debt funds, whether you are holding it for 12 months, 6 months, or 48 months, it is always direct addition to your income, the profit, and it will be taxed according to your slab rate. Now, hybrid equity-oriented fund. If you hold in for less than 12 months, it's short term. If you hold it for 12 months and longer, it's long term. Hybrid debt-oriented aggressive hybrid funds, 12 months is short term. Hybrid debt-oriented funds is always short term, and long-term capital gain again always short term. Now, coming to the taxation, equity mutual funds, arbitrage funds, because they are basically equity funds, and other funds where more than 65% is invested in equities, and if you are holding them for it, will be taxed at 15%, while long-term capital gains will be taxed at 10% without indexation. Debt funds, whether you are holding it for any time, it's going to be usual rate of income tax slab, which is applicable to your income. Conservative hybrid, same. Holding period does not matter. You are going to be taxed at your usual slab rate. Aggressive hybrid fund is yes, because here allocation of 65% is must for equities. If you are holding it for 12 months, less than 12 months, it will be short-term capital gain at 15%. And if you are holding it for longer than 12 months, it's going to be 10% without indexation. So this is a distinct advantage. Investment in equity-oriented mutual funds for a longer period is going to save. So your pre-tax and post-tax difference is going to be really beneficial here. Now, how do you invest? What plan do you want to invest? I will always insist that you must invest in direct plans where you are not going to take any dividends. Whatever profit the company is making or your investment will be retained with the company, and you can withdraw it at your need time. That is a direct plan. And regular plan is a regular income plan. There is second definition of direct and regular plan. When you are buying your mutual fund through a distributor or any agent in between, like your bank, they are selling you a product, then they are going to earn a commission on it, and they will allocate a regular plan of mutual fund to you. But when you do it on yourself, go to the office of that fund management company in your city, or doing it through platforms like Grow and IndMoney, you can escape the distributor's commission. You can minimize your expense ratio. So distributor is the entity which I want you all to eliminate. You should be able to do it directly either through asset management companies or through like apps like IndMoney or Grow, which are very user friendly and easy. Now, how do you select the fund? If you want to do fund selection on your own, you should have a knowledge. Now, coming to fund selection, which is the most important top, you should know certain things about that fund. And where do you get in this information? I will tell you. Criteria of fund selection, first and foremost, how old is the fund? Any recent entrant has to prove its worthiness in the market. So I do not invest my money in a very, very fresh fund unless it's a sunrise sector like say defense, and now maybe semiconductors and all those things coming up, electric vehicles. I don't know, I have not yet put my money in such a fund. So age of the fund for me, minimum 3 years old, ideally 5 or 10 years. Past history, though it's not assurance for future performance, past history does play an important role. Corpus under management, how much money is invested by the investors in that particular fund, in that particular category. So minimum money I look at is 2,000 to 3,000 crores for a smaller fund. But if it's a large cap fund, if it's more than 10,000 crores also, it's good. Too much heavy corpus of fund is not good, because if a fund manager makes profit and he wants to sell a particular script where he has already made a lot of money, but that script belongs to a small cap category and he has a very large holding in that script, it may be difficult for him to liquidate his position, because his offer of sale will create a turmoil in the market and that share can fall. So depending on the category of the fund, a large cap fund may have a large corpus, a mid cap fund should have a middle range of corpus, say 5,000 to 10,000 crores, and a small cap fund should have a lesser corpus for convenience. Returns, past history, 1 year return, 3 years return, 5 years return, and 10 years. You get this information on your apps as well as various websites like Value Research and Morningstar. Expense ratio, how much fees the fund manager and the fund house is charging. If it's unreasonable, you compare with the similar funds in the same category, look at the returns and look at the expense ratio, and then decide which share you want, which fund you want to invest in because of convenience. And the exit load. If you want to exit too early, say less than a year's time, some companies charge you some premium, and that is known as exit load. Lesser the exit load, the better. Reputation of a fund manager. Well, I have not really gone into reputation any time, but theoretically, yes. Look at the name of the fund manager and Google it, and you will get his past history, how efficiently he is managed his various funds, and you can decide on that. Risk reward analysis. There are various indicators and ratios, which I will come to it shortly. And rating and ranking, which is important. Now, ranking, rank is decided by the performance of the fund. So it will be compared, the performance of that fund will be compared with its peers for last 1 year, 3 years, 5 years, 10 years, or since conception. And you will come to know the rank, where it stood as compared to its peers in that particular time frame. Better performers can be selected. And rating is usually done by this Value Research or Morningstar on the basis on risk reward analysis. So higher the ranking, better, more stars is better. So very safe fund will have a 5-star rating. A little less safe will be 4 stars, then 3 stars, 2 stars, and that way. So risk and rating will appraise you of the performance and the competence. Now coming to the various ratios, these are very important. Alpha, it's a unit to measure how much our fund outperformed its benchmark. Fund manager works hard and does a lot of research to gain an edge over the rest of the market to generate alpha. Higher the alpha, more is the return. That's a simple figure. If alpha is 5 means your fund has given you 5% more return than the benchmark index. Beta is a measure of volatility. It shows you the proportion of volatility of the fund against the benchmark. So, low volatility is less than 1. Higher volatility is more than 1. More volatile is the fund. When the market goes up, this fund will go up more than the market. If the market falls, this fund will perform more miserably than the market. So, in a market like today, where the indices have risen very high, one should adopt a strategy to put your money in low beta scripts. Standard deviation. It measures the degree at which mutual fund returns vary from its historical annual return. So it's a comparison with itself. Yearly performance it will compare to in the past. So Canara Robeco Blue Chip Fund, for example, has a standard deviation of 14%. So it gives plus or minus of 14% returns as compared to its previous annual returns. So it's a comparison with the self. The more the standard deviation is more the volatility. But it's not compared with the benchmark. It's with the self. Sharpe ratio. It measures excess returns on every additional unit of risk taken. How do you know additional risk? It is compared with the safest debt instrument, say like RBI bond rate or a fixed deposit rate of State Bank of India. And if you are taking extra risk, how much more money you are generating, or if the market falls, how much you are losing. So both ways movement it will detect. Higher the Sharpe ratio, the better is the fund. One must compare this with peers in the same category. So comparing a large cap fund with a mid cap, Sharpe ratio does not make sense. Sorting ratio is very important because it will give you measurement of only downward volatility, downward risk. We are more interested to protect our capital. So it will not take into consideration the higher figures in standard deviation. It will compare only lower. When the market falls, as compared to the risk which you have taken, what is your return standing? Where is this standing? Instead of standard deviation, it adjusts the fund's excess returns over the risk-free rate only with downside deviation. Higher number is better in the same category. So if you are comparing Sortino ratio of various large cap funds, higher the number of Sortino, better for you because downward deviation will be lesser. Now, where do I do the analysis of individual fund? There are two popular sites. One is Value Research, where you will get all these ratios, 1 year performance, 2 years performance, 3 years performance, 10 years performance, and also on Morningstar. These are two most popular websites where you can study your funds. How do I screen my funds? See, if you take Business Line, every Sunday edition of Business Line, on the second last page, they give you a full chart of leading funds, top funds in the Indian stock market. I have told you already, there are 44 fund houses and there are 1,440 schemes available in India at present. And total amount of money which is invested by the investors in these mutual funds alone is 51 lakh crores, that is 51 trillion rupees. This growth has been stupendous, especially in last 5 years. Or you can buy Economic Times Wealth Creation on Mondays. Both these newspapers, they give it the data which is researched and published by Value Research. Now, this is the page. I'm sorry, page is so big, it's very difficult to make out what is there, but I have tried to take a closer picture and show you equity large cap funds. You can see the latest NAV of any fund. Then how much is the corpus under management? See, for a large cap fund, it's not unusual to have a corpus of more than 20,000 crores also. Then the expense ratio. Now look at the expense ratio. A regular plan, if you want to buy through a distributor, it will have an expense ratio of say 1.7 against direct, which you are going to buy yourself from the app or from the asset management company itself, is just 0.4. So your return is 1.3% better here itself. Then you have 1 year return, 2-year CAGR, 5-year CAGR, 10-year CAGR, and the last column, which is very important for us, is Sortino ratio. So amongst all the peers in the large cap, you can see here that the Sortino ratio of 0.27 for Canara Robeco Blue Chip Equity is probably the best. Now, this is the book, which is a Bible of mutual funds. And now this is already February 2024 issue, which is open, of Value Research. I am a member, premium member of Value Research. I get this copy every month. There is a detailed scorecard of all 1,440 funds here. You can see here, equity large cap. You can see the rating. You can see return 1 year, 3 year, 5 year, 10 years. Now look at the rank. So which is the best rank here? Number 1 rank here is ICICI Pru, Bharat 22 fund of funds, which I talked about just a while ago. Look at the returns. Look at the expense ratio, NAV, and assets under management. So this is a scorecard, and they give you a full data bank of all the leading 1,400 funds here. Now, how do I do my risk reward analysis? My presentation actually is over here. I will come to it a little later. Now, how you should do allocation to the mutual funds. I have some money. Should I invest in stocks? Depends on the tenure of the investment. This is the most important thing. If your holding period is going to be less than 6 months, then better keep it as a cash in the bank account or a liquid funds. If it's going to be between 6 months to 2 years, it's better to keep it in debt funds or gilt funds where your stability of income is ensured and the return will be slightly better than the fixed deposit. If it's going to be more than 2 to 5 years, well, then you have option of balanced funds, where 100% switch from one category to another, debt and equity, is possible for a fund manager. If your horizon is longer, 5 to 7 years, put your money in large cap stocks. Still longer, 7 to 10 years, mid cap funds, high risk, high return category. And if it's more than 10 years, it should be small cap funds. So this is normally what I suggest to my friends, colleagues, and relatives. Now, age-based allocation. This is as general. It's not only funds. If you are between 10 and 25 and 40, you should allocate only 10% towards debt investment, 40 to 80% towards equity, nil to 10% in gold. Real estate, now maximum 40 at the age of 25 to 40, because everyone has ambition to own your own house. Then insurance, mediclaim, indemnity, term insurance. It's a must between 25 and 40. And cash, how much cash do you should keep? Only 6 months expenses. 41 to 55, as your age increases, your allocation to the debt increases, allocation to equity becomes less. Your gold holding should never be more than 10%. Your real estate.
Sir, sorry to interrupt you. I think we are almost 1 hour done, and we have to take question and answers also.
This
so
is my last
probably
slide. Actually, I wanted
yes,
to
sir.
show you the most interesting part also.
Sure, sir. Sure.
Okay, I'll just show you one part. See, this is the most interesting part. Now you go to a morning star and select the fund of your choice. Here I have selected, just now it has come, Nippon India Large Cap Fund Growth. Now there are very different tablets here. Risk and rating. You get a graph. There is a x-axis and there is a y-axis. That's a graph. See, this is the return on y-axis and x-axis is standard deviation. Now red dot is an index. Your index is at midpoint of returns as well as standard deviation. This is the overall ranking of whole category of large cap funds where return is at par or little less than the benchmark index and standard deviation is around 14. Nippon India Large Cap Fund has a standard deviation which is more than the index, but return is distinctly more. So whenever you look at this graph after opening the tab of risk and return, ideally your fund should lie here, left upper quadrant, less standard deviation and higher return. And most of my funds I buy on that criteria alone. And this is available on Morningstar. Select a fund which lies in left upper quadrant, less standard deviation and higher return. And that's the end of my talk. Thank you very much for patient listening.
Thank you so much, Bhagali sir. It was an excellent talk. Whatever I have heard till date on mutual funds, it is one of the best talks I have ever heard. Thank you so much, Bhagali sir, for accepting our invitation.
Thank you, sir. Thank you very much.
Sir, we have so many questions. So, Jai Bhai, Amya sir, please start question answers. There are so many questions in the chat box also.
Yeah, I think most of the questions have already been honestly covered with a very good descriptive analysis, which sir has already mentioned. And but there are 2 or 3 questions which probably we can take over here, and the rest of the questions we can take in our WhatsApp groups. So,
so
one
WhatsApp, and I can keep on answering 2-3 questions every day, no problem at all.
correct. So, sir, one thing, one question, and which somebody has asked is mutual fund versus ULIPs. Which one is better, in your opinion?
Insurance plan, I don't believe in insurance at all.
Okay.
Whatever units you are buying of mutual funds, they are gradually withdrawn towards the premium of your insurance. There is no additional tax advantage. So I had done it in the past, and insurance is not a tool to invest. So I am strictly against ULIP. I will follow mutual funds only as a tool of investment and not as insurance.
I think that's a very important point, because a lot of times people confuse that, and they get carried away thinking that एक तीर से 2 निशान हो जाएगा types.
नहीं,
So, and that's a very well said point, sir.
Expense ratio is very high. Expense ratio
Correct.
is very high.
Correct. One question which I think is interesting, and this has recently been posted, is how to prioritize between paying loan versus investing. I think either Ritesh sir or Bhagali sir, anyone can take over this, because it's an interesting question, I think.
See, actually, this has nothing to do with the mutual fund, but still,
it's got nothing to do, but it's an interesting question.
Cannot be done without. See, if you have sufficient cash flow, at what rate do you buy? Take a loan? 11%, 12%,
Correct.
And if your investment is generating 14% or 15%, why not do investment simultaneously? So keep on paying your EMIs, keep on paying your interest. Anyway, interest payment is going to be tax-free if it's for profession, or it's for car, or it's for home. Partly it's going to be tax-free. So you are using money tax-free at a lesser interest than the returns you are getting from equity investment. So stick to your EMI only. Don't repay more than what is needed.
Okay. And I think one final question, again, that seems to be an interesting question. Can you elaborate something about the systematic withdrawal plan?
No, I will get back to it on the group, because systemic withdrawal plan is monthly withdrawal. Now, previously, what used to happen, we used to invest money in the mutual funds and hold them for a year and start withdrawing to avail of long-term capital gain tax. But now, companies like fund houses like Nippon India, they have schemes where they already have a corpus of other investments ready, and you can start withdrawing from the next month after the investment and still avail of long-term capital gains tax. So systemic withdrawal plans, you have to study each fund house's strategy. According to me, Nippon India is the best strategy for systemic withdrawal plan.
Okay, so I guess with this set of 3 or 4 questions, we will call it the end of the session for today. And I once again thank every member who has taken out time to attend this session. I extend a big thank you to Dr. Bagali sir. Yes, sir, your final finishing comment, sir.
Thank you very
Jitin
much. It was very interesting for me also. And please give me feedback so that I can improve, keep on improving on this.
Sure.
Right.
What people expect and what I deliver, there should not be too much of gap in that. So it should be, reproducible. People should understand it, and they should take away some points and start investing on their own. That's the aim.
So we
Yeah.
always have a joke that lectures are like balance sheets. If you go through the same balance sheet the second time, you will understand more. If you go through the same balance sheet on the 10th time, you will understand even more. So I hope this session is seen multiple times by all our members, and the excellent platform which everyone has provided for this. So thank you to Ritesh sir as well. Thank you to Amay Joshi sir as well. And Ritesh sir, your concluding remarks, and then concluding remarks from Amay sir.
So special thanks to Jay sir for providing his platform. It has been really very nice that as soon as I put a request for the use of Zoom platform, Jay bhai immediately called me, immediately told that we can use this platform. It is more than 1,000 members. Thank you so much, Jay sir. A special thanks to Amya sir for taking out his time on a precious day and on the afternoon for conducting this session. On behalf of all the moderators, thanks to Bagali sir for taking his precious time and giving us so many good insights about the mutual funds. So thank you, and Amir sir, please conclude the session.
Yeah, all of you have expressed thanks, so I echo them. Just some homework for Dr. Bagli sir. I was going through the questions one by one. Sir, just for the beginner's sake, please do put in some funds for maybe sleeping investors who can just start investing and continue doing that, because many are not tech savvy and just want simple.
This is the book I was recommending. Huh?
Yes. So can you just put that in the group as well as the 2 resources which you go through every week,
sure.
the business standard and the magazine,
Sure.
so that those who are weekend readers, so that is for them. And for those who are day-to-day investors, I think all your talk carries so much of a meaning. For those who want to revise, as Dr. Jay said, he will be putting it on his YouTube channel and will make the information available in the group. If you have any questions, please feel free to put them in the group till the weekend. And I think sir has promised that he will be happy to answer. Also, please feel free, if not directly in the group, to our individual numbers also. You can just give a feedback on what you want to learn, what you learned, or is there any other scope for improvement. I thank one and all for your patient listening, for joining, and heartfelt gratitudes to Dr. Bagli sir. I think it's a privilege and honor to have you here. Thank you once again.
Thank you very much.
We call it a day.
Yeah. So to all the guys, the recording I shall make available in the next 30 minutes on our WhatsApp groups. Okay.